Welcome out to the Trading Justice Podcast. Absolutely massive week behind us. We're going to break down all of the key technical and, more importantly, some interesting storylines. We're going to talk AI. I am super excited about this. One of the things in all of the, news and the headlines and the earnings has been the emergence, or I should say the reemergence of, I think what my brother has been referring to as wave three of AI. Going to get his thoughts on that as we break down some pretty decent earnings on Microsoft, on Meta. We're going to get all into it. Before we get going, though, Tackle Trading. This is the podcast this is who sponsors our podcast. Amazing place to learn how to trade. Amazing place to learn technical analysis. And coming up this coming Monday, we have a master trader workshop that is a boot camp for technical analysis. Matt, talk about that. Pitch the newsletter for us while we're at it.
Yeah, for the pro members coming up, we got our monthly master trader coming up on May 5th. It's going to be a one-day master trader this month, and it's going to be an awesome show. Coach Gino, myself, going to be teaching that on Monday, so definitely come check us out. You can register for free at tackletrain.com. Hit the link in the description below. It's free for pro members, so definitely sign up for that free 15-day trial and come test out our foundational course in Master Trader. It's an awesome class. You'll love it, no doubt about that. And for the newsletter, the pro members newsletter coming out later on today, and for your weekend homework, and it's going to be a doozy this week. We got major updates on the technical side of the equation. Bear stop out got confirmed. Certainly going to be looking at upgrades and talk about what to look for next. I know you're going to have some economic thoughts in both the economic section and the global markets as well. So definitely check out that newsletter and the Traders Report. Those are the two go-to reports for Tackle Train pros every single week.
Yeah, listen, who would have thought, what I'm writing about in the economic piece, we'll cover this a little bit later in the podcast, right? Who would have thought in a week where you had a negative GDP print, recessionary fears would have reduced? We'll talk about that here in a little bit. Want to dive into technicals before we get going, Matt. That newsletter that I write the economic section for, you write the heavy lifting on the technicals. One of the things you have done in recent weeks for our pro members is talk about, all right, there's a lot of different outcomes that come watch here, but you have emphasized what we in tackle trading refer to as the bear stop out pattern, right? You've emphasized that, you've anchored, you've been watching about that, and like, listen, you might be a macro bear, you might be concerned, you might be this and that, but if you get this development, watch for it. You've talked about it, well, guess what?
Well,
it's kind of what we saw.
Everybody's going to have an opinion in these moments in time, right? When economic data is mixed, fundamental data is mixed, we're obviously going through volatility moments and there's concern on the future. Everybody's going to have a strong opinion in that moment. But for me and a lot of other people that tackle trading, it really does become a technical story when everybody's focused on the macro and the concern on the economic data in the macro. That takes some time to play out, quite frankly. And we start seeing that a little bit this week. We'll get into that here in just a second. But at the end of the day, I just truly believe it's not what people say in this environment that's important. And that's really difficult because everybody has an opinion. Jamie Dimon has an opinion. Larry Fink has an opinion. Goldman Sachs has an opinion. Everybody has an opinion. What's the economy going to do here? What's the economy going to do there? How's consumer sentiment going to be impacted based on tariffs? How are tariffs going to impact long-term data? Like, everybody has an opinion. Those opinions play out long-term, and I'm not trying to discount those opinions. I have concern too. But to me, in these environments, it's going to be a technical saga because technical analysis tells the truth of the market. You might not agree with what the market's doing based on whatever purview you personally have or whatever bias you have or however you're reading the macro condition or the headline news. I mean, you go to Twitter and you look at some of those headline news, you're wondering why the market's up here. Well, if you look at the technical side, what have we been talking about over the last 2 weeks? Bear stop out analysis, pulling up the case studies of trade war number 1 in 18, pulling up the case studies of the 2020 pandemic and tracking how their technical formations developed so that we have an understanding of the past, how we traders, how we investors, how our society, how supply and demand, how consumers, how corporations, how government, how central banks, how all these different market participants behaved in that environment in like-minded scenarios of the past. And when you go back to the past and you look at 2020, for example, well, what do you have when you go back to 2020? You have, and again, I've had multiple times in the last couple weeks, had our community repeat the pattern. Deeper retracement, shallow pullback, breakout. Deeper retracement, shallow pullback, breakout. That's the bear stop out pattern. And in 2020, what'd you get? You got the retracement to the 20-period moving average, shallow pullback. And that shallow pullback is so important because that's the first increase in support. And so that first increase in support puts you on the backdrop for the bulls have a little bit of control for the first time in a while. And then they break out. Well, it's off to the races, but it's not off to the races like the market just completely leaves you behind. It actually consolidated for a good month after that initial move up before you got the larger run in the pandemic case study. You go back to 2018 in the trade war saga one in 2018. And what do you have? Deeper pullback, test the 20-period moving average, shallow, deeper retracement, shallow pullback, test the 20-period moving average, breakout, good run, simple consolidation before you get into a giddy up and go type of trending environment. And so there's always going to be uniqueness to the environment. There's always going to be uniqueness to what we're going through in each market correction. Is it going to be the big one, circa 2008.com? Is it going to be something more like we see routinely, once or twice over a 3-4 year period? Well, typically speaking, markets find a low point, they go through a short-term reversal situation, and then when everybody in the world's like, oh my goodness, the end of the world is happening, all of a sudden the market breaks out and people are like, whoa. Well, to me, Mark, and you've heard me say this before, context is for kings. And in these environments, context matters. And that is a very difficult thing for a lot of human beings to have when they're seeing the headlines and the impact and the political messaging that we've seen over the last few weeks, how it impacts how we all see this environment. But to me, when you anchor technically, you're anchoring to the truth of the market, and the truth is based on how human behaviorals impacted the same degree of environments in the past. And those same degree of environments in the past, when you look at the past, you look at those case studies of 2018 and 2020, well, I'm not shocked we're seeing it play out very similar since we've had that conversation in the newsletter and at Tackle Trading in general for the last 3 weeks.
Yeah, no, listen, and you've done such a great job guiding the community through technical analysis. Like, technical analysis is just incredibly important, and it's just not one wave. I mean, the thing about trends, the thing about pattern development is it provides multiple opportunities. I know a lot of individuals. I mean, you go look at fund managers, they got left behind on the move up, right? Adding as we go. Guess what? If you're like, I should have bought at the lows. Well, guess what? People have that in COVID. They had that in 2018. Yeah. They've had that at every stage. It's the next pattern, right? Focus on the next pattern that develops.
And again, I think that's a really important message here on the technical side, Mark, because when you look at the past, just because you got confirmation on bear stop out doesn't mean you missed anything. Right. Those are the early stages where it's still a very sensitive probability conversation.
Matt, I missed the COVID bottom by a mile.
You didn't miss the trend.
But I think 2021 was better, but I had my either first or second best year ever.
Everybody misses the bottom. Get off that. And I'm not saying you, I'm saying everybody. Get off that. Your job isn't to pick the bottom. Your job isn't to pick the top. Your job is to find the trend.
Your job is to make great trades and great decisions, right?
Where's the trade? Where's the trend? Make those decisions. Absolutely.
Yeah, listen, okay, I want to get into, in the decisions we make in the coming days, transfer to a new segment. I want to talk about the AI trade, because there's been a lot of noise in the market. And in the noise, sometimes, the forest, the trees, what's the forest? Traders get lost and they forget things. Things are fast moving, right? Like right before we started recording this podcast, China said, hey, we're open to discussing the fentanyl deal, right? Listen, been a lot of headlines. One of the stories, though, that we should remember from this little time period, as all the headlines swirl, is the reemergence, what you, I believe, have been referring to as wave 3 of the AI trade. Now, I have a lot of questions. I want to discuss this because I think this is a very important story. In fact, for me, it's been the story of the last couple months outside of all the headlines and stuff like that. First of all, I got a few questions for you, and I want to discuss, Meta, Microsoft's earnings here in a second. But I want to know why you are referring to it as wave 3 of the AI.
Well, a couple reasons. Number one, there's been a substantial time between the growth narratives of wave 2 versus where we are today. There's been a cooling off period. There's been a contraction. And so, for example, when you look at the Qs, Mark, we and the Qs represents kind of the NASDAQ and obviously the AI trade. But when you look at the Qs topped out last December is when the Qs topped out. We've had 5 months of either double top action or a short-term bearish downtrend. And we don't need to rinse and repeat the saga of February and March going into April. But Mark, the Qs topped out in early December, not January, not February. And so you've had a good 4 or 5 months of cooling off period in the AI trade. And even in the AI trade, I would say you've actually started seeing slowing growth for about 6 months in the AI trade in general. And there's been waves, segments, however you want to describe the AI trade. But I see the AI trade, and why I call it wave 3 is because wave 1 was really semiconductors and NVIDIA. Once NVIDIA came out with their H100, the first AI chip in late 22, early 23, all of 23 became the wave 1 of AI. AI is here. Look at these LMSs. Look at all these, understanding the 6 segments of what the AI marketplace is all going to be about. That's when I came out with the AI Gold Rush webinar, and I started producing the AI Gold Rush watch list, was kind of in that wave 1. That lasted through a lot of 23, but there was a cooling off period towards the tail end of 23. Coming into 23, 24, you really started expanding outside of select companies, because wave 1 was really it was Taiwan Semiconductor, it was NVIDIA, it was AMD, it was a semiconductor move in general. Wave 2 is really software infrastructure. So you obviously had the chips in there, but you now add software to that component. You add the infrastructure to that component. And that's where CapEx spending became so bloody important, is where you started seeing the infrastructure side of it play out. That's where you started seeing downstream, right? Instead of just the top level AI names, you started seeing an impact on the downstream. And I expanded the AI watch list in that environment during wave 2 to basically 3 tiers: tier 1, tier 2, tier 3. And you had to include software components in that. You had to include infrastructure components in that, because we started seeing the expansion. Well, there's been a lot of cooling off period here. And a lot of that was due to some concern out of Taiwan Semiconductor on the guidance side of the equation a couple quarters ago. You also had some concern out of ASML, one of the more important companies on the infrastructure side, a couple quarters ago. Still some concern on ASML there as well, even today. And then a quarter ago, you had Microsoft warn on CapEx spending, which really sent a shock to the system, because we're in a massive AI arms race with China. And that's our advantage. Like right there, that's our advantage. CapEx spend, the billions and billions and billions and hundreds of billions, if not trillions of dollars at this point, that these major companies are spending on the AI development. And that put a slowing growth argument on the radar, and really had an oversized impact on the market in general. Well, a couple of weeks ago, you got Taiwan Semiconductor's report.
Yeah, I mean, that was like I knew you would mention it, but is where
it's because I made this statement on the report that this would have been the starting point of the AI wave.
I remember you saying this. Listen, no, yeah. When it came out a couple weeks ago, we were in tariff chaos. The only thing anybody was talking
Taiwan
about,
Semiconductor gapped down on a positive earnings report that I thought was awesome. Yeah, and I said it was stupid at the time, and I still think it's stupid today.
And you mentioned, you're like, listen, remember this moment, right? Mm-hmm. Remember this moment.
Shockingly, that also equated to the increase in support in the S&P 500 as well, Mark. There's some correlation there. I'm telling you, right? There's some correlation there. Now, obviously, it's been a tariff alleviation type move. But on the backdrop, I'm sorry, we're probably seeing those earnings a little bit different if it isn't for Taiwan.
This is important though, right? Tariff alleviation can help create a rally.
Oh, absolutely.
Tariff alleviation can take you only so far though. For next legs, right? Like you're just not going to rock this.
Tariff alleviation leaves the volatility and it gets into recovery. It doesn't create a trend.
It doesn't create a trend, and that is important.
Recoveries, it doesn't create a trend.
You are going to need other storylines. You're going to need other narratives.
And here it is.
Other things, and here it is. All right, you're talking about Taiwan.
And so you got Taiwan Semi, who came out and said CapEx spending is strong. And that was a complete reversal about what Microsoft said just 3 months ago. And they said it's not just the hyperscalers either. We're starting to see it downstream. And that's a big impact because again, think about it. You got the hyperscalers spending hundreds and hundreds of billions of dollars. But what did DeepSeek prove 3 months ago, Mark? DeepSeek proved that you can build those learning management systems for a lot cheaper than what it was expected to cost, hundreds of millions of dollars, for example, before DeepSeek. And so Taiwan Semiconductor comes out and says, well, we're seeing, the hyperscalers increase spend, but we're also seeing non-hyperscalers increase spend as well. And I thought that was a big time point that was missed by the market, quite frankly. Taiwan comes out, pulls off the hat trick, has a great report. And then you have this week where you got two big dogs on the CapEx side of it, Meta and Microsoft. And Mark, I just felt like Microsoft was like whatever somebody got to them on their last quarter earnings and they said, you can't say that stuff again. Somebody reminded them about the CapEx importance here. And Microsoft came out, they didn't expand growth on CapEx, but they did say that they are looking to expand versus what the 24 environment was. So it kind of wiped away what happened last quarter. Microsoft increases guidance. And it wasn't just the increase in guidance, Mark. One of the things about wave 3 on the AI trade is you're talking about monetization of AI. That's not been a big part of the saga so far. It's been infrastructure, it's been growth.
It's been excitement. It is about the possibilities.
Exactly. But with Microsoft, part of wave 3 is monetization. And Microsoft came out with their Azure, which is their AI platform, their cloud-based platform. And they had 33% growth on Azure. And half of that was based on AI. Half of that. So I just thought Microsoft was great this week. Meta came out and they increased CapEx spend as well. ServiceNow last week came out and they had a good report. You got Palantir next week. That's a little bit of a different saga than some of these other stocks, as that's at the high point. But it's out of all the companies that have been reporting, I heard Jim Cramer say today on CNBC. And don't quote me, but it was in the ballpark. Earnings season has been good. And I'm like, Kramer, what are you talking about? It has not been good. We've been reducing guidance. We've had EPS beat rate less than the average, EPS total beat percentage less than the average. What he's talking about, though, is there are certain companies like the AI trade that have stood out in earnings. And so I wouldn't describe earnings season as good. I would describe it as below par. But I would say out of all of the earnings saga, the AI type names do stand out.
Yeah, they certainly do. And that, that CapEx spending, because one has to remember, long before the tariff saga came upon us, tech was declining. And it wasn't declining on tariffs. It was declining on worries over CapEx spending, that the AI trade was unwinding. One thing that's easy to forget.
Tariff was dumped on top of a market that was already slowing down and already concerned on CapEx.
Yes. People were like, well, the tariffs was the start of the, no, it wasn't.
It wasn't. It was slowing growth on AI. People, see, that's the thing about people who listen to, that is not what occurred at all. What occurred was Microsoft warning on CapEx, Walmart warning on the consumer.
Microsoft gap downs on their
tariffs got dumped on top.
Yeah.
they got dumped on top of already concerning consumer environment, already concerning earnings environment with the CapEx side. So it wasn't tariffs that started this saga.
Yeah, no. And so, like, having those stories that can build upon themselves, that can carry tariff alleviation will only take
By the
you
way, I'm
so far.
calling wave 3 the race to AGI.
Yeah. And it's important to understand this story and download our AI guide that Matt wrote. We're going to put a link in the description wherever this video can be found and wherever the podcast be found. Download that AI guide because you need to understand this story. It's the next waves of trades. It will provide you opportunity. And I want to close this segment on a comment from NVIDIA CEO. When he's not signing people's chests, he is dropping some pretty good analysis. And he was out in the last couple of days and he's like, listen, everyone, China, you would like to think China is this distant mile behind us on AI. It's not. It is right behind us.
Okay.
No, but
I get what Jensen was saying there. I also don't believe Jensen believes what he was saying there. But China is behind us on the AI build-up, but they're catching up. They're catching up.
But you will agree it's a race. And
I also agree that what DeepSeek did, and Jensen knows this, is that it's going to force everybody in the US to pick up the competition hat and start doing this a little bit quicker, a little bit bigger, and a little bit faster. I'm sorry, what Jensen said, and he's seeing it play out in earnings season this quarter. He's talking about DeepSeek from 3 months ago, and that was a dagger to the heart of the AI arms race. What he knows that he's not saying is that also sparked something in these American AI companies. We are not losing that arms race to AGI. That is not occurring. We will throw the kitchen sink at this issue. And I think Jensen's trying to play a little political games to make sure that the administration also understands the importance of that because he was there this week as well. And so I do think there's some political games being played with that commentary.
There might be some
I do not believe China is caught up to us on the race to AGI. I still think that's American.
But it is some fuel, and it is like, listen, we're not going to, like, it's on the AI story. You're not just going to be like, okay, that was a cute little thing.
Oh, I think what Jensen was doing was bullish for the AI trade.
Yes. Like, and so, yes, tariff alleviation.
Hey, guys, if you don't take this a little bit more important, what's going to happen here? China's going to catch up and win to AGI. We don't want that. So it took me about 0.001 second to realize what Jensen was doing with that comment.
Understand the AI story, download that AI guide. Matt has been all over this for years. It's an important story to understand, an important story to build watch list around. I want to take us to our next segment. I believe it's becoming a trader's market, right? We're seeing, rallies in the indices. We are seeing, chart setups in different areas. And one of the things, and you alluded to some of the numbers, and I want to get your overall take on earnings here, is that, there's been a lot of, like, this earnings season seems to have been a time period where if you didn't provide guidance, the market was If you did provide guidance, the market rewarded you. And I really think this backdrop, Matt, is, we haven't had a great traders market for a while, right? There's been a lot of spot volatility up. This feels like it is developing into a trader's market. Give me your thoughts on that and some, like, just high level stuff on how earnings.
That's what the overall AI growth narrative will do, is force a trader's market on you, no doubt. But we're starting to see separation. The first couple of weeks of earnings season, 2-3 weeks of earnings season, there was a lot of muted responses. I saw the market really kind of taking into account the macro far more than the macro obviously being the tariff conversation, micro being their raw numbers and their guidance. I saw a lot of companies pull guidance and have a lot of wide-ranging guidance. And that certainly happened this week as well. But there's some key differences this week on earnings. You started seeing the market price in earnings following Wednesday so much more typical. It felt like a typical earnings season. In the first 3 weeks, it was like, all right, there's some weird stuff happening on the pricing element side of the equation. But you just think about the 4 big dogs this week, right? You had Meta, you had Microsoft. Both Meta and Microsoft had good reports. Both of them pulled off hat tricks. Both of them increased forward-looking guidance. And what did they get? They got the gap up treatment. Meta gapped up, looking really, really good here. Microsoft gapped up, and obviously looking for secondary development on both of those companies. Whereas Apple warned, had a guidance concern there. Obviously, Apple is very sensitive to some of the tariff and international conversation. Amazon, very similar to Apple in that 70% of Amazon products get some degree of sold through China. And so obviously those two have some concerns on the guidance side of it, but the market's discounting it. So you saw some gap down, but some recovery. But the two that reported positive guidance saw gap up. That's a lot more normal pricing. By the way, I do like Amazon here, and I like Meta. I think Mag 7 leads, and I think the AI trade leads as well from a growth narrative perspective. But I really kind of felt like you started seeing more normalcy in the marketplace. And I think that's important because you're right. I don't feel like this is going to be initially it's an index conversation, right? Because all indexes were correlation of one, all indexes kind of do the same thing. But from Wednesday on, Mark, we're starting to see separation. We're seeing leadership out of the queues. We're starting to see leadership outpace. You take a look at, for example, the QQQs, that you're already at the 200-day moving average. I mean, that is a V-shaped recovery at that point. Well, you'll take a look at IWM. Mark, IWM's not sniffing. It's trending in the same direction, but it's not sniffing that. You're obviously seeing separation there, and a lot of that separation was this week. Not all of it, but a lot of it was this week, and we started seeing that at the back half of this week. And so, yeah, I think we are going into a little bit of a trader's market, and I do think as we're getting into the back half of earnings season, and the tariff conversation isn't having as big of an impact on pricing, that you can start feeling a little bit more comfortable outside of just intraday analysis as well.
Yeah, no, and those setup. And one of the things that stood out to me in following earnings was business to business seemed to really hold up, right? Like if you were not consumer facing, the business to business, and this is one of the things that should give a lot of confidence in the market in general, right? Consumer facing companies very hesitant to provide guidance because of the unknowns. Right, business to business seem to really have a better handle on.
Well, I mean, Microsoft's big business to business. Meta, I mean, Meta's obviously a different take, but take Microsoft versus Apple, right? One very big on business to B2B. That's Microsoft. One on B2C. That's Apple. Which one had the better guidance? Which one had the better environment? There's some concern on the consumer side, and that concern on the consumer side does predate the tariff conversation. That's obviously impacted it, but it does predate that. And so we're still seeing some of that concern play out here on the consumer side of it. We saw it with earnings this week. And I think that feels a little bit of the fire of the separation, no doubt. Even in consumer discretionary, I think you're going to have some haves and have-nots. So to kind of go off and, at the end of the day, I would say I agree with your comment that this is starting to feel like a stock pickers market, and stock pickers markets those are traders markets.
Now let's go to the next segment. One of the interesting storylines in a very busy week was you have a negative GDP print and you end the week with recessionary fears calmed a little bit, right? You're not going to see that very often in your trading life.
Oh.
In fact, that might be the only time you ever see that ever happen again, where negative GDP print and by the end of the week, recessionary fears were lessened. Explain why that's the case, Matt.
Explain why we got a negative print, but the market.
No, explain why. Okay. Here, I'm going to tell you why it's the case. No, I'll tell you why. Listen.
Okay.
The negative GDP print, right? Now, there's been some slowing in the economy. There's no doubt. In fact, Atlanta Now GDP, they came out with their latest forecast. Next quarter, they've lowered it from 2.4 to 1.1, right? So there's been some slowing. But one of the reasons the GDP number was so graphic was that you had some real anomalies going through the system this last quarter. A lot of companies front loading, goods
in front of the tariffs,
in front of tariffs, and import data. When the United States, when companies import, that actually takes away from the GDP calculation. And so because there was so much import data, along with an absolute...
You sounded like Peter Navarro there, buddy.
With some actual... This is one thing Peter Navarro left out.
I know he was getting some heat this week, and I am very quick to dump on a Peter Navarro right now. But I I think context matters in these things, and especially when you're trying to evaluate a -3%. You can look at the headline, and this is the mistake consumers and people on Twitter make all the time. They post the headline like they actually understand what's actually transpiring here. Like they post the -3 headline. Like I saw it all week long. I saw it out of a lot of liberal Democratic type influencers, political messaging type thing. Oh, GDP, we're in a recession, 0.3. I saw it out of the banks. GDP, 0.3, we're in a recession. And I'm like, okay. First and foremost, a recession technically is -2 consecutive quarters of negative GDP. So why don't we try to understand what's behind the -0.3 before we just make the assumption that that is the end all be all end of the world? You remember when we had those 3 consecutive quarters of unemployment going up, and everybody came out last year, Mark, and like recession, the end of the world is happening. Psalm roll. Every time the Psalm roll comes out, we see the markets, and both you and I were like, this is so stupid. Like these rookies that don't understand economic analysis coming out here and trying to understand, oh my goodness, the Psalm roll or this roll or this roll. Or I can go back 7 years ago and during the pandemic. No, before the pandemic, like 2 years before the pandemic. People like inverted yield curve. Every time the inverted yield curve goes down, and I'm like, doesn't the QE environment change that analysis? Like, doesn't the things that we're seeing transpire from 08 to 2020 change how the inverted yield curve works? Like, aren't you going to update your systems at all in the modern environment? And so you go back in time in these recessionary type conversations, and there's always going to be people to pull data to support their argument. That's not how it should be done. You shouldn't have an argument and pull the data to support the argument.
No.
The data should provide the argument. And so to me, for me to understand how much recessionary risk is out there, obviously it's elevated to versus where we were a few months ago. I'm not trying to make an argument that it's not. But at the same time, there's been multiple times in the history, Mark, where everybody in the world was saying recession and the end of the world. And here I am saying, no, what? I'm going to carry the bullish flag here, because context matters. Context in economic data it matters. It just does. You have headline numbers, and then you have what is behind the headline numbers. And what is behind the headline numbers is the context. And context is for kings. It is there for people who want to be above the fray. And so to me, the context on the GDP report is this. There were 2 things transpired that had a sizable negative impact on the GDP that won't be impacted next quarter. And I'm not saying we're not, if the consumer craters and
this is not the final dictate on whether we'll have a recession
labor implodes and we see more layoffs and all that okay, there's other things. I'm just saying for this print in this quarter, you had a sizable impact. Number one was the import data. We had a surge in import data, positive 41%, as corporations were trying to front run the tariff announcement. That included a record amount of gold being imported in from the UK into the United States. That import data, front-running tariffs, is not going to happen next quarter. You might see it a little bit because of how the quarter-to-quarter works, but you're not going to see it nearly as much. And so the first thing you're really looking at is that import data, and you're saying, okay, import data is having an impact. The second one is the tariff announcement. The tariff announcement, and this was according to Peter Navarro in his press conference just a few days ago, had about a 3% impact on GDP. Now, the tariff conversation certainly can't continue to have a 3% negative impact on GDP. But Mark, where are we at in that tariff negotiation? Because it feels to me like the White House, the Trump administration, and other countries out there around the world are trying to find some degree of solution to this conversation. And there might be some, like, for example, the EU slated to talk with the administration next week. We got most likely announcements coming out of some like India and some other countries out there. The big one, obviously, is China. And even China over the last 24 hours has signaled their willingness to engage in some hypothetical thought process of a hypothetical meeting at some point, which you might say, well, Matt, that's a lot of hypotheticals. And I'd say at least they're saying hypothetical. That says something. And so I just think within the next 2 to 3 weeks, maybe 30 days, give me a little leeway on this one. I just think within 30 days from now, we are going to see the tariff trade war conversation differently than we do today. And I think we see the trade war tariff conversation differently today than we saw it even 10 days ago.
Yeah, no. And listen, don't bet against the monthly unemployment report.
Yeah.
If you've bet against the monthly unemployment report for the last few years, it hasn't worked out for you very well.
No, labor's strong.
Bet the over. Always bet the over.
Remember last month where everybody was like, the labor market's going to implode because of Doge. And now this month, it was like the labor market's going to implode because of tariffs. In the last 60 days, we have not seen the labor market implode. That's all I'm going to say.
No, and the plain and simple fact, you are still going to have recessionary talks in the background. I've been around this business a long time.
And there should be recessionary talks. I don't want to come across as suggesting that this is this ridiculous conversation, because it's not. It's a very important conversation. I just think we should have it on the very important data that will either lead or not to whether we have a recession or not.
Yeah, so, listen, until the labor market actually cracks, that conversation is not going to have a lot of fuel, right? Slowing growth is market overvalued.
The labor market numbers were really good for the market today.
The wage growth down and all that. A report that Ben Bernanke would be proud of, for sure.
Would be proud.
I want to do a quick check-in on gold and Bitcoin. One of the things that we've seen in some alleviation of the current situation is gold kind of hesitate, pull back a little bit. We're seeing some really strong patterns in crypto. But before we get to either of those, and Matt read my mind, right? What's the dollar doing? There's some bottoming action. And you've made a comment a couple times this week, Matt, that I found interesting, that the sell America trade seems to be a bit overdone right now, referring to Treasury in the short term. Yeah. Right. And you'd have talked about if the dollar finds some strength here, you could see some short term between trade war optimism and a labor market that doesn't crack and a dollar that maybe ascends a little bit, right? Watch gold for maybe a little pullback. What's your take on it?
I usually, when I see the world say that the dollar's going to lose reserve status, and I've been having that specific conversation for well over 10 years with our community, and they don't know anything about what even a reserve currency is, I kind of have a tendency that there's things happening out there that we need to take a look at. On the dollar index here, I do believe that the sell American trade has went a little too far. We were talking about the end of the reserve status, not you and I, but we were talking about the scenarios that could play out a few weeks ago. And one of those was loss of reserve status. And now, based on my analysis over the last 10 years, I do believe we will continually lose reserve status up until the point where we get to about mid-40s on the percentage of totality of international reserve being settled in US dollars. But I don't believe we will see the end of the dollar in my lifetime. And so when you're looking at the dollar here, I just kind of feel like that conversation went a little too far, a little too fast. And like, it just got to the point over the last week or so, maybe 2 weeks mark, where everybody is like, America's going to be left behind. America's going to be left behind. I'm like, the $30 trillion juggernaut known as America is going to be left behind. Come on, guys. Like, don't you think we might be going a little too far with this before we even see what America has to say about all these trade discussions, trade deals, hypothetical scenarios out there? And at the end of the day, when you talk about the reserve nature of the currency, you always got to ask yourself a question. At the end of the day, whose currency are you going to hold? Are you going to hold the hypothetical nature of the up and down economic scenarios and military scenarios of Europe versus America? You're going to hold the Chinese yuan and all of their issues versus what the United States has? I just think that's absolutely ridiculous. And so to me, I just feel like that's went a little bit too far in the short term. And thus, we're seeing a little bit of slowing momentum on the dollar index. And my concern on the dollar index was specifically not to the marketplace. It was specifically to gold. And I kind of felt like if we were going to see slowing momentum on the dollar, we were most likely going to see further contraction in this retracement on gold. And so it's just a short-term conversation, not a long-term conversation. As we're seeing the slowing momentum environment on the dollar, that should have an impact on gold by bringing gold back down. So the analysis on the dollar is really not about the dollar. It was really about gold and having the understanding that this short-term pullback in gold is really kind of just starting because of what we were looking at with what was going on with the dollar. And so I'm still looking at the pullback scenarios on gold. I'm still looking at the pullback scenarios on GDX, and I'm very interested in them. You know, I mean, GDX right around 46. You see some development there. That's a beautiful, beautiful level to start tracking. You got the 50-period moving average right underneath that. And so you definitely want to see some development here between 46 and 48. But, you know, it's at a level that you will want to see that development. When you look at, you know, GLD, you could kind of say, well, GLD, you're underneath the nine's, you know, frowning at this point. That's going to be a tough challenge against the 90 EMA. You got a price target right around 290 on GLD. That is fairly attractive from a demand zone perspective. And so I just kind of feel like let this gold analysis play out through the depth of the retracement conversation. And if you don't understand the depth of the retracement conversation, I would strongly encourage you to get into Master Trader and start learning how to navigate the 3 core patterns within an existing trend. If that's all you ever focus on as a trader, is just focusing on the 3 core patterns within an existing trend, you are going to be a great trader for a very long time. So
you do not need to master every element of technical analysis to improve your results.
You do not need to be able to write a book on technical analysis to apply technical analysis.
Understanding the basics, because I don't consider myself a great technician. I use technical analysis,
but you certainly know how to navigate the 3 core patterns within a trend.
But like the basic stuff, like when I see the basic stuff,
master the core.
Master the core, and
master
like it's remarkable. It's just remarkable what it can do. Crypto patterns looking pretty frisky. Quick debate, Matt. You can have one asset for the next 12 months. Bitcoin or gold?
I will never, ever, ever, ever choose Bitcoin over gold if you give me a 12-month horizon.
I will choose Bitcoin. I will choose Bitcoin. And I think this environment's made for crypto.
Yeah, you're right. So, and the last 900 years has been made for gold. So you're right.
Okay,
you're
boomer.
Right. Well, if 900 years makes you a boomer, I'm a boomer.
Listen, I like gold. I like gold plenty. Just I would take Bitcoin over the next 12 months.
I can't disagree.
It's a beauty pageant. It's a beauty pageant.
Pick your one. I love, if you were going to tell me in the next 12 days, I would say Bitcoin.
Well, yes, next 12 days. Well, that's an easy debate.
In the next 12 days,
it's got a high base pattern that's breaking out, right?
I like IBIT here.
Very good chance that Bitcoin finds, upward momentum here, right?
I'll tell you, if you were to say for the next 12 weeks, I might say Ethereum.
Ethereum has a lot of catch-up potential.
I think the Ethereum pattern here is still kind of just dialing it in, and it's getting saucy. It's getting pretty interesting with that 50-period moving average. I haven't done anything yet on it. I know Coach Greg, he's already doing things on it. He front runs every reversal.
I added a couple percent cash flow to my portfolio on Ethereum this week. I'm looking to maintain.
I will look upon a breakout of the 50.
Yeah, I added this week. We'll continue to look as long as it stays behaved. These levels, it's just hard.
It's the levels. It's the levels. But keep an eye on the 50-period and the 90 EMA on the weekly chart. Both of those are really good trigger, and they're both in around the same zone.
If it runs to 3,000 quickly, I'll leave that for the momentum traders, but I certainly love getting involved at these levels. All right, last segment real quick, then we're going to get into a couple questions real quick. Matt, next week, not a lot going on. There's still going to be a lot of earnings. You mentioned Palantir. There's going to be other earnings, right? A lot of the big heavyweights are done. There's almost nothing on the economic calendar, but we do have a Fed meeting. Jay Powell still has a job. Still has a job. and I think the markets are pricing in a 98% chance, last I looked before we started the podcast, that there will be no cut.
You can put me on that.
Yeah,
Yeah,
so,
you can put me on that.
if we would have had a weak labor market data today, it would have been worth 30 seconds of conversation. Hey, what if, right? But I don't, that's not going to
The
happen.
labor market coming in 40K above expectation gives the Fed all
they're not
room
doing
they
anything
need necessary to not do a thing. They can basically
In fact,
listen, we got inflation coming in at 2.8% on the PCE report. We got a strong labor market. We are very happy with where monetary policy is. We'd like to see how this plays out for the next couple months. That's the message. That's what you're going to hear. And it's going to be surrounded by 1 billion data points on tariffs that may or may not have any impact downstream.
In fact, you have seen June odds dive pretty noticeably on a rate cut down to kind of in that 50-50 range the last time I checked. Right. So it really sets the stage, right? There's going to be no anticipation.
If they come off, again, this an if A then B scenario, but if they come off tariffs and we don't see the short-term spike in inflationary pressures, Trump might get what he wants on the rate cut side. Maybe not in June, right? But he might get it in July.
And so I mean, rate cuts are coming in unless something abnormal happens.
If the current environment stays the exact same, he's getting his cuts this year.
Yes, he's just not getting them as quickly as he wants, right? Like quickly as he wants. But like it's kind of a boring setup. Maybe it's just kind of what kind of tone does Jay Powell have? But it seems very catalyst free on the Fed. Any wild cards that could come up next week on the Fed?
I'm thinking about the amount of things that I care about more than the Fed next week.
See, that's the amount of wild cards that can come up, right? It's just
I can say Palantir 14 straight times if you want. Disney, I'll even say Disney earnings. I kid on Disney earnings, but Palantir, I would definitely put Palantir above that. I'm very interested in Palantir. Palantir better be they got a sky high earnings bar next week. I'm just going to say that, but I love that little company. They're not even little anymore. They're a $300 billion juggernaut that's going to become a $600 billion juggernaut. So I'd say Palantir 1 next week. I think that's the most important data point coming into the market, especially from an AI trade perspective. They're a tier 2 company on the AI saga. The Fed next week's important. Obviously, the Fed's always going to be important, but I kind of know what Powell's going to say, and I don't think Powell's going to try to change the conversation at all. And so I think it's going to be a non-story, honestly.
All right, let's finish up our podcast. I've really enjoyed the conversation. I thought there were some really interesting storylines. Pro members, be sure to check out that newsletter. And if you're not a pro member, man, just the technical analysis knowledge, sign up that Master Trader next week. Got a few questions in our Coach's Corner. Finish out our podcast, Matt. Number one, I had a lot to choose from this week between the lounge and 1 cent in. But, as the earnings expert, I like this one. I got a couple different versions where they were asking specific companies, but I was phrasing the cumulative amount to what was your earnings report that stood out to you this week?
Meta Microsoft obviously stood out. CVS. If CVS stood out, they had a pretty good report. They stood out. Let me look at my notes very quickly here, Chucky, just to kind of from the standout perspective. 2 reports that stood out off the beaten path. So everybody knows about the Microsoft and the Meta report. CVS did stand out to me on the earnings side of the equation. Another one that stood out was Honeywell. I thought Honeywell had a fantastic earnings report. Honeywell came out with a 13% beat. Revenue was up 8% year over year. They increased forward-looking guidance. And aerospace and defense companies have not had a great quarter, in my estimation. Honeywell comes out and says, we're pretty good. And it is at a level that you want to track to.
That is a fantastic looking chart if you develop.
Right? I think the 215 level is a fantastic development level on Honeywell.
Mid-tier breakouts have been fantastic for years.
So off the beaten path, I would say Honeywell, I would say CVS had a really good report this week. PWR, Quanta Services, had a really good report. They came out with a 26% beat. They raised guidance. They were up revenue 24% year over year. And every single week, I write about the best and the worst earnings reports, give my macro earnings take, get our community ready for next week's earnings in the newsletter. So if you're not a pro member, you know what to do.
Listen, next question.
Oh, can I get it on the downside?
No, this has been a positive. No,
Okay.
listen,
Okay.
listen.
We're thinking positive. Okay.
You'll get your bear porn sometime in August when the yields
BDX.
spike.
I just want to throw it out. BDX.
When yields
they
spike
had
to
a terrible report.
4.7 and the new bear market is upon us, then we'll start getting gloomy again. Too many AI possibilities right now. So no, get your negativity out of here. All right, next question. You know, you're a Forex guy. You started with Forex. The question is,
I didn't start Forex, but it was early. Yes.
The way you talk about your early days, it would be easy to misinterpret. It would be easy to be like, no, I just was trading Forex day charts all the time. Like you talk about all the time. But the question is, if I wanted to start trading currency, where would you start?
Well, I'm always going to say start with education. That's you definitely want to start anytime you trade. If you have some experience, technically speaking, trading stock, trading options, like those are going to be really good. If you want to embrace the leverage markets of the Forex and the futures market, both of them are highly day trading assets. There's no doubt about that. Where I would start in currency is I would start by trying to understand the major currency pairs. I would start by trying to understand the definitions. That's all going to be about the Forex 101 course. Cody Mackey did it a few years ago, did a great job at then. So for the pro members, I would say Forex 101. And then we've also done some webinars recently in the coaches show. I did a Forex 101 coaches show just a couple weeks ago as well. So if you're a pro member, check out that coaches show I did on currency just a couple weeks ago. Check out Cody Mackey's Forex 101 as well. And then I would focus on the major pairs. You don't need to really get into all the cross stuff. You don't need to get into the exotic pairs. When you're looking at most currency trades, the vast majority of currency trades, I think like 27% of currency trades are settled with the euro dollar cross pair. When you take into account like the top 3 currencies, that's like 60% of all currency transactions. And so the benefit of the currency market is you don't have to scan through 2,000 stocks and have all these different option strategies. It's a directional market. You got to learn how to trade cross pairs and understand the definitionals of it. That's why you want to check out the coaches show I did, and that's why you want to check out Cody Mackey's Forex 101. Also, Keith King did a few coaches shows a few years ago on that as well. Search within Tackle Trading if you're a pro, but I would start with those educational offerings, and then I would focus on the major currency pairs and specifically the euro dollar.
Next question, and we got a couple of versions of this. The specific question that I liked though was regarding daily routine, right? As a new trader, we're always trying to establish routine. Experienced traders will preach the importance, and the question was, how do I start developing a daily routine? I am struggling to find consistency in mine.
That's a fantastic question. Routine's very important. One of the things we try to do in our content at Tackle Trading is help people with their daily routine and the content that we create on a day in, day out basis. For example, I would start with morning action every day. Morning action, we put the video in morning action that will basically break down the technical conditions of what's happening in the broad market, the commodity market, top companies, top news of the day type thing. And so if you look at morning action here, you got the video that will help you understand what's going on that day. You got the top 5 stories, you got the heat map to understand. And so I would start with morning action. Then if you come over to the trade ideas, Frank puts his top trade idea in every single day. So if you love clean charts, beautiful patterns, and great potential trades, well, Frank puts his best technical trade there every single day. And then obviously you can check out some of our shorts that we put out there on morning action as well. But I would start with morning action, Mark. One of the things we try to do with morning action is go through the daily routine, identifying the markets. What are the markets doing? What's happening from a sector perspective? What's going on in the global markets? What is the news of the day? Did any economic reports come out? Understand the landscape, understand the environment before you ever even go into your trading routine. So many times people will just want to get up, wake up, grab that cup of coffee and get out there and start doing their deal. Well, you got to get a lay of the land first. You got to understand the environment you're dealing with that day. That's what we do in morning action. So if you're struggling with your routine, you're not going to struggle anymore if you make morning action part of that routine.
Yeah, and we do that Monday through Thursday. And then Friday, when we do the podcast, we upload the podcast there as a place to watch the podcast with the top things we talked about in the different segments. So, like that routine is so important for traders. Matt, I have been loving the podcast. I just love whenever you have an active market, right, stimulates the brain. I always love these conversations. But send us out, brother.
Send us out. Well, thank you so much for being the best part of Tackle Trading and Trading Justice podcast, and that is our community at Tackle Trading. You guys are the absolute best. Thank you so much for always showing up, showing out, and making Tackle Trading absolutely great. It's been absolutely fantastic. Also, we are actually hanging out in Discord doing a live recording of the podcast, and so if you are a pro member, you can always come over to our Discord channel on Fridays and hang out with us while we do the recording of the podcast. So hopefully our community enjoyed that here today as well. With that said, guys, we got Master Trader coming up on Monday. If you're a pro member, definitely hit that register button. If you're not a pro member, 15-day trial, hit it in the link in the description below. And if you love the pod, it helps you navigate the world, the financial world on a week in, week out basis. You get great ideas on it, or you just love having a conversation we love having as well. Hit that like and share and help us out with the visibility of the Trading Justice podcast as well. With that said, I hope everybody has a wonderful, wonderful rest of their week.
Yeah. Have a great week, everyone.